Hello investor, have a happy family day. And as you can see on my screen, the Money Sense magazine has not only one or two but top 100 dividend stocks of 2021. So what a good way to start a family day. So you can easily see, I'll put a link to this website to, so they have listed the 100 top 100 Canadian dividend stocks based on some ranking and all. So the how to use this table and all, but it's pretty straightforward, honestly. So if you can see, they listed the ticker, they listed the grade, grade A, and then some grade B. Surprisingly, all the banks, they didn't put in grade A. So it's in grade B, and there are some in grade C as well, which is, yeah, as you can see here, and the D as well. So nobody wants to go to D and C, of course, or at least D, but let's see which one is grade 1. Okay, the first one, and out of the 100, the very first which gives the very good dividend yield is the Manulife. So this is not just based on the dividend yield, but they use some other methodology as well. But because as we can easily see, within the grade A, there are some other tickers, for example POWG, WO, which has the higher dividend yield, or even this one, Capital Power Corp, 5.87, but still they didn't list as a number one stock, right? So these are still the dividend yield, but not in the same group A, but not as the number one stocks, right? So yeah, so these are the ones. So let's what I'll do in today's video, I'll put a link there, and also continue to do the stock valuation to see, okay, is it really a good stock or not. We do use the models, we use the ratios, price, dividend history, and so on, just to do some independent analysis. And if you want me to do something similar on other stock as well, feel free to comment it out into today's video to see whether this is a really a good stocks or not. We'll perform the dividend, we see the dividend growth and so on, and also do the stock valuation at the end. So if I see the dividend history of this stock is from 2001 to 2020, which is a very fairly long time period of 20 years. The first 10 years the stocks almost increase when the market crash, right at this time. And then they cut the they reduce the dividends, not cut the dividend, but still maintaining the dividend. And for few years the dividend were pretty much looks like increase or stale, and then it get picked up in the last 5 years, and we can see the dividend growth is there. So this is a good news for the dividend investors. But overall, if I see the 10-year, the dividend growth rate is 5 year, right? But in the last 5 year, the dividend growth rate is growing at the rate of almost 10%, which is consistent on 1 year and 3 years growth rate, which is phenomenal, right? Which is very good. If I see also on the payout ratio, how the number which I get is 35%, right? So that's on the January 2020, but the last year we know that the market is not very good, so its raise comes to around 42% for this January 21, but still it's not bad, it's within. So this is the history from 2016 onwards. So the payout ratio, the lower is better, don't take the payout. So this means the company is only using 35% of its earning to pay the dividends, right? Which is not bad. We also need to consider this by using the debt and others. So if the company has huge amount of debt or not doing any income, then for sure it doesn't make any sense. So we'll consider all these things as well. So before I move on, let's quickly see the price. Maybe this is the price. So for example, if this is the 5-year Yahoo Finance chart, and right now this is the MFC.to ticker, this is showing the Canadian price 24. If I do the equivalent, you just divide by the multiply by the exchange rate, which is around 0.7, and you'll get around 19 point something for the US investors. So right now the price in the Canadian market is 24, almost 25. When I did this video on the few months ago, that time the price was around 19. So according to that price, the dividend yield was very interesting even at that price, over 5% as well. But it's not bad as well right now. So if I see quickly the 5-year, if somebody has invested in this stocks around bit ago, so pretty much even if the market volatile coming down, the person must have almost double. If I include the dividend income as well, pretty much and get its return back, 100% investment back, right? So from 15 something to now. Okay, so let's see some of the gross margin and returns. So we are on the ratio side right now. So the gross margins, if I compare with the last trailing 12 months to the 5-year margin to see within its own benchmark how the company is performing. So if I see that, look at that. So this is the 10%. This is pretty good, right? So the 10.31% as compared to the operating margin to the 11.78. So this is not selling any goods. This is the insurance company we know, and pretty very popular insurance company. So that's why I didn't go over the business profile. I think in one of my my earlier video I already did that. So feel free to check it out if you really want it. So if you see that this is in this graph, it's doing better not only on the operating margin but pre-tax margin as well, and after net profit it's doing pretty even. So that's pretty good. So that's what the graph easily we can see on the graph. Next, on the management effectiveness, how management is doing in terms of the return on equity, which is a very important ratio, as we know how much return on our investments we are getting, or this for the equity shareholders, right? So this is increased, right, as if I compare to the 5-year average, which was only 10%, but now it's even 12.5% or close to 12.5%, right? So which is good. Okay, so let's do the stock valuation now. So here I will be using today's two models, the net profit models and the free cash flow models. This is a pretty stable company, so I thought just use two models should be more than enough. The reason for that to not using the enterprise value model is the company almost has pretty much less or no debt. So I think that the debt equity ratio is 33 if I'm not. So that's pretty low. So if I see the revenues for the 10 years, so we'll get the from 51 to 58, right? So the 2 years, so I'm taking here the 19. I'm just want to show here when I compute this ratio 2020 because of the market volatility or the bad in the market. But still, if you can see, the company is able to maintain or increase the net profit margin, right, from 4 to 4.2, and the revenue is a little bit decreased, but the net profit margin is still increased, which is pretty good sign here. So the net profit growth for the 2 year is 65.15%, which is good, whereas the 5% is, which looks more reasonable. I think this is not a growth company, so maybe because this happened because of the drop in one time in 2018, and then they pick it up on 2019. So that's why we take the different the stats on the different matrix to see what makes sense. So I'm taking the net profit growth rate for the short term is 4.68%, and then reducing this growth rate to the 2%, which is more reasonable as company will go as per the economy. So, and then I'm growing this net profit as we get from 2020 income statements to the next 20 years based on this growth rate. As you know, if you are following my channel for a long time, then I use the required return of 10%. So if I use the required return of 10% and discount this the future the earning by that, I'll get the total earning is $54 billion, right? And then I know my current share is 94 billion share outstanding. So if I divide by these twos, my price is $27, almost $28. So that's what the price is. So just want to let you know that these numbers I'm taking, this is in US based number, and then I'll convert it to the CAD number, because this is the company is also listed in US. On the free cash flow, again, this is I'm getting the free cash flow per share, and then when I divide by the number of share outstanding, I get these shares. So basically it's $1, 1.5, and then almost 1 to 8. If I see the free cash flow growth rate, which is quite disappointing that the company is not able to save enough cash, right? So it's reducing the free cash flow. It's not paying enough dividend as well, but that's what it is. So recently, the reason is company is paying is debt. So start doing that, and also so that's we can see here. So that's affect as the free cash flow. But on the free cash flow yield is quite pretty significant, which is good, like a high in single digit or in double digit for last 3 years. So if I stake, okay, my free cash flow even is growth rate is reducing heavily, and I assume that okay, for the short term it's still negative, but during the meantime it can cover to 2% as well, and then I take the terminal value of 10. If I do the math, my share price is coming from this model is $11.60. So now I got two share price from two different models. And so far, if you like this video, please give a thumbs up and really appreciate that. And if you want me to cover any other stocks, something like this, or feel free to check my stock valuation series, where I use usually 2 or 3 models to come up with the stock price. So I really admire that on that one. Okay, so based on the two models, if I gave them equal weight 50%, from the first model to the second model to this, so the price in US dollars come out to 1977, which is a fair price in the US market, right? And if I do the just convert it into the FX, and then the Canadian market is 25.70. If I see what's the market price right now is 24.88. So I do say this is the fairly priced stock as per these models. So if this is a fairly priced, then the dividend of 5% which the company is paying, which is pretty good as well. So so that's it about it. So don't forget to subscribe and comment if you already own this stock, or this is your or any other companies, your favorite stocks in the Canadian or US market from the dividend perspective. So do let me know in the comments, and thanks for watching this video. Bye for now.